Hi, I'm Howard Lothrop, host of Echo Partners TV, and today we're going to talk about the Earnings at Risk report. Specifically, we're going to talk about how to interpret your Earnings at Risk answers and how to turn your Earnings at Risk report into one of the most important tools for management to use in running the bank, at least from the perspective of interest rate risk. First, let's start with a brief overview of earnings at risk. As you may recall, earnings at risk is a simulation approach where we model cash flows. It generally is, we're looking at a 12-month earnings at risk. We're looking at how interest income changes, interest expense changes, and of course, because we're looking at both of those, how net interest income changes. And that's really the bottom line measurement of earnings at risk, the change in net interest income for the bank given any particular rate shock scenario. And we're all familiar with the typical bar chart or line chart that shows earnings at risk. If it's upward sloping, that is, if net interest income is increasing as rate shocks in an upward scenario, rates moving up, you're said to be asset sensitive because your assets are repricing quicker than your liabilities. A downward sloping chart showing net interest income declining in the face of rate increases would reveal the bank to be liability sensitive. So far, so good. But here's, there are two factors that are really key to getting the most out of your earnings at risk report. First of all, you should have an asset liability model that provides not just a 12-month earnings at risk, but also multi-period, 2-year, 3 to 5 year perhaps. But again, extending the time horizon for the earnings at risk calculation. The second item, and this is the one that really hones in on the use of earnings at risk as a management tool, you should have line item earnings at risk. That is, we don't just want to look at the total interest income or total interest expense. We want to look at each of the component pieces and see how they vary with respect to changes in the rate scenarios. Now, one of the less well understood concepts in asset liability modeling and management is that in order to calculate the total interest income, the model you're using must calculate each of the component pieces. What they don't always do is report those out to you in a usable format. So that's job number one. Job number one is to get that line item detail, because with that line item detail, it's pretty straightforward to make a good usable management dashboard that shows exactly which asset and liability line items are influencing the simulation to a greater or lesser extent than the others. And that's what it's all about from interest rate risk management perspective. It's one thing to know that our interest rate sensitivity is asset sensitive. It's another thing altogether to know exactly which line item is causing this sensitivity, and so you can rank, order, and prioritize those that you're going to work on first. And that's really the key to successful and productive management, and that is prioritizing your approach to these issues. One final tip for earnings at risk: you want to look at earnings at risk on a line item basis, certainly, but you also want to look at it in both a dollar and a basis point perspective. That is, we are used to seeing net interest income in dollars, which then are rapidly and often converted to percentages. But it's highly important to see this in a basis point or yield perspective as well, because that's one of the things, again, that's well understood in the bank. That is our net interest margin, our managing our spreads, and managing our yields both on an asset and liability basis. Well, that's it for today. Remember, let's get the line item detail and look at this on a multi-year as well as a 12-month horizon. And then let's take it one step further to be a great management tool with both dollar and basis point analysis. If you have any questions, let me know. If you have other topics you'd like to see us cover on a future episode, please let me know. Thanks again, and we'll see you soon.